So, folks, we have a Fed that is now, it seems to be starting a rate cutting cycle. But have you asked yourself why? Stock market at or near all-time highs. Gold seemingly making an all-time high every day, silver included. Then we've got crypto. Then we've got real estate. Why are we cutting rates when we have all of these assets at all-time highs? It's time to get into this with Taylor from Life Goal Investments. Taylor, what the heck is going on?
Yeah, it's funny. You can scratch the back of your head when you look at things and you go, man, it's pretty clear that the employment market's starting to slow down. It's pretty clear that we don't have a perfect handle on inflation at this point, and yet we've got every single asset class at all-time highs. So I think it's confusing market. I think there are reasons to be optimistic. I think there are reasons to be pessimistic, and we can talk about any and all of them.
Yeah, it's funny because not only are all the assets at all-time highs, but I have a list of economic notes that or data that come out in the last week, and all but one were barn burners. I'll give them to you. New home sales, weekly jobless claims, durable goods, existing home sales, personal income, personal spending. We just had pending home sales this morning. All of these were monster beats to the upside or to the betterment. The only one that was weaker than expected, consumer sentiment, which is really interesting because consumer sentiment's like, how do you feel?
I don't care how people feel.
Yeah.
You're going exactly where I wanted to go. Who
Yeah.
cares what someone says in a survey? Show me what the numbers say.
Exactly. And show me what they're doing and their spending. And then we've got people like Ken Griffin saying things like, it's feeling a little bit like the .com era. Then we got people talking about the Buffett indicator, which has never been over 200% and is now. So bubble everywhere and the Fed's cutting. Do we just blow this bubble up or what the heck is going on?
Yeah, I think you got to rewind a little bit and understand why this was created, right? We just went through the most epic fiscal and monetary simultaneous stimulation this country has ever seen. So there was just an ungodly amount of money pumped in the market, both out of DC and out of the monetary policy. You had stimulus checks, you had PPP loans, you had rates held and locked at zero. You had all of these things that just created this euphoric nature to the market. And we're still kind of leading off the back ends of that. But when I look at it from the positive side, what's going well in the market right now? Well, corporate earnings really have been pretty darn strong. Now, to be clear, the bar got set pretty low, reset pretty low last year, but companies really are performing very well from an economic standpoint. You look at earnings, not only are they beating earnings, but the projections for earnings going into next year are getting ratcheted up at a rather feverish pace. And that says that companies are handling this really, really well. And I think that a lot of it comes down to a couple underlying factors. One is you've got rates low. Rates are low and going lower. So their access to capital is going to get cheaper and cheaper and cheaper. So that's helpful. Two is you've got dollar weakness. The dollar weakening, as much as, politicians might say, we love a strong dollar, we love a strong dollar. They don't. They want our dollar to be weaker, like every other politician around the world right now that's kind of in a race to devalue their currency. It just makes our exports so much more competitive. And then you've got oil low as well. And I don't think that oil ever goes dramatically higher. I know that's such a controversial thing to say, but we literally can drill down into hard shale rock. We can drill down thousands of feet. We can drill sideways 4 miles.
Right.
Like our technology is just absurdly efficient. And so I think that, are there going to be periods of time where OPEC pulls oil off the market? Yeah, there are. And you're going to get, short blips. But I think we have the remedy for that. And we've never had the remedy for that before in our lives. And that's why we don't have the big seismic shock of downside risk that oil can produce.
Yeah, when I look at this, because I knew we were talking today, two things kind of struck me. First, I'll go to gold, right? I've never been a huge gold bug. I've always jokingly called it the yellow rock, but it's a tremendous asset this year. I think last time I checked, it was up like 45. It might be up 50%, this time of year, and seemingly hits a new high every day, silver included. But when I ask myself why, and I'd love you to check me on this, I actually think it's more of a international story than a domestic story. I think what's happening is foreign countries are increasingly moving away from the U.S. Treasury and just buying gold. And, if you drop, 5% of U.S. Treasury purchases and that all goes to gold, that's a new demand that didn't exist before, right? That's what I think is happening with gold. Am I on something?
Oh, you're 100% correct. Well, it started when we just froze Russian assets in the
Yeah,
US Treasury market. And people are
exactly.
like, well, now we can't trust the safe asset in the market because we don't
Exactly.
trust the US government's not going to say, hey, your money's mine now. And I
Yeah.
need to find that other safe harbor. And traditionally, that safe harbor has been gold. And gold is something that we use in our client portfolios. The reason that we use in our client portfolios is not because we're gold bugs or something like that. It is a great diversifier. You know, you think
Mm,
about there's typically kind of four parts of the economic cycle. The economy is in a growth mode, it's in an inflationary mode, it's in a stagflationary mode, or it's in a recessionary mode.
yeah,
And
contraction.
gold
Yeah.
works in three out of those four environments. And the one that it doesn't work in is that typically that growth mode, but that's when other asset classes typically are ripping.
Mhm.
So we actually decided we were going to utilize miners, and that was not a function of like loving miners or anything. What we wanted to do was have a smaller position size in gold,
Right.
and then have it act larger. So,
Mm,
but miners have a beta of 3 to gold. So if gold goes up
gotcha.
or down 1%, the miners are going to go up or down 3. So you can have a smaller position and have it be a more outsized impact. And the
Like it.
miners are on a rocket ship. I think they're up
That was a very good
120%.
call.
I think they're up 120% year to date. There was a little bit more
Oh,
to it. They're also taxed more efficiently, and there was a
yeah.
dislocation in the market of them versus gold. So whatever. But
Yeah.
but we're a believer in gold in portfolios because of what it does to the overall complexion of the portfolio.
Yeah. And then I step back and I look at real estate, obviously a place I play a lot at. And again, the Fed broke the market. We've done a couple of things, kind of at the macro level. The housing is, we froze the housing market, meaning a lot of people are going to stay in place longer. In the real estate world, that's called turnover. Something I said years ago is turnover is going to go from an average of roughly 7 to 10 or 11 years. And that ripples through, the entire cycle, right? We're going to push out transactions for quite a while. So again, we broke the market. We froze shelter cost for a lot of people at artificially low levels, which is a net positive to the economy, right? If you have shelter cost that's 800 in a world where it should be 15, you've got an extra $700 to play with, right? Just because you got lucky and refied at 2.5%. So I think that's a net positive. Also, it means that the housing market's frozen. There's no inventory at the low end, things of that nature. But then when I step back and really ask myself what's going on, how can we have seemingly all assets at record highs and the Fed starting to cut? I just go back to the fact that we printed, what it was, at $9 trillion, and the M2 money supply broke off trend, and it's going to be years to get back to trend. And maybe that's just that simple, right? It's always an M2 money supply issue, and we've got more money in the system than we should. So more dollars chase fewer assets get more expensive. Maybe that's all this is just M2 money supply doing its thing.
Yeah. I don't think you're wrong. I think the complexity that comes along with this is kind of the K-shaped economy that it creates. And I think that most people know what K-shaped economy means at this point, but for those that are not familiar with that term, it just means that the rich get richer and the poor get left behind.
Yeah.
And that it's a sad story, one. And two, it's a story that is just a sheer function of, and it wasn't a political party. It was both. You had Trump pumping, you had Biden pumping, and then, Trump kind of pumping again right now with rates low and taxes low, et cetera. But what it does is it really inflates markets, right? And you have all that capital getting pumped into the market. It inflates asset prices. And so that's kind of where this weird dichotomy is playing out, where I think that the upper end of the market, I was at the Ryder Cup this weekend. You would think the money was not on there. So I blanked out there for a second. So I was saying I was at the Ryder Cup, and the fact that the amount of money that was getting thrown around, you would think that money is no issue to anybody on earth. And that is so far from the truth, right? But that's the higher end of the market. And the lower end of the market is seeing kind of inflation continue to whittle away at their purchasing power. They're seeing jobs that aren't as fruitful as they were 2 years ago, and the ability to bump from one to the other and get a massive pay raise, that's just not happening now. And it's an interesting dichotomy.
Yeah. Tom Barkin, Fed President Tom Barkin, actually said the front of the cabin is full, the back of the cabin is empty, right? That's the K-shaped economy, right? First class is full, but the back coach is not. And, I think you hit the nail on the head, because one of the things I'm putting a message out there is how to get wealthy. And you've kind of said it. It all keys on owning assets, right? That's the key to this. You've got to figure out anything you could do to stack disposable income, cut expenses, create more money or income, and then buy assets. If you want to get out of the middle class, own assets. I mean, the game, don't hate the game, right? Don't hate the rules. Play the game, play the rules. And if that's the rules, play the game, folks.
I tell our clients, a lot of them, something very, very bluntly, is if we have done nothing else for our clients throughout the entirety of our careers, it's get them comfortable coming out of cash. Right. And I don't care what it is you're buying, right? Buy real estate, buy stocks, buy bonds, buy a productive asset, right? Cash is like this drug to people. It's like that warm, fuzzy blanket that they put on themselves that they feel so good about. But at the end of the day, like, that is an unproductive asset that will have its purchasing power eroded over time. You have to take risks to stay ahead. And that is the game that is being rewarded so much in the market right now for all the reasons that we just discussed.
Yeah, let's close on this. I think after the Fed meeting, the dot plot, all of that, folks are pricing in 2 cuts for this year and I think 2 more next year. Given all this positive economic data, can we really count on 4 cuts in the next, I don't know, 6 to 9 months? Is that even feasible with all this great data?
I think it is. I think it is, because I think the Fed's focus has shifted. I think the Fed's focus has clearly shifted towards the employment market.
There you go. Jobs over inflation. You heard it here first, folks. Taylor, where can people find you?
Yeah, find us at Life Goal Investments. That's our handle on both Instagram and on TikTok. We're doing 60-second daily videos there.
And again, folks, if you haven't checked him out on Instagram, I don't know how he gets 5 minutes of value inside 60 seconds. It's mind-boggling, but he does it every day. So keep it up, Taylor. Thanks, buddy.
You're the man. Thank you.